This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to The Commercial Investing Show, where we analyze, explain, and exploit the opportunities presented in today's commercial property marketplace. If you're interested in apartments, mobile home parks, self-storage facilities, and other income property, you've come to the right place. We'll explore what's hot and what's not in markets nationwide in the relentless pursuit of return on investment. Here's your host, Jason Hartman.
It is my pleasure to welcome a guest whose work I follow and really enjoy. I've been wanting to get him on the show for a while, and here he is. It's none other than Lance Lambert, the co-founder of Resi Club, who does some fantastic research into the real estate market, taking deep dives into the composition of everything under the sun. So it's really great to have him. Lance, welcome. How are you?
Yeah, doing great. Really, thank you for having me. And, back in October, I left Fortune magazine, where I was the data editor to found Resi Club. And the goal is to build a news and research company that tracks the residential housing space. And, according to CoreLogic, the largest asset class in the country, it's not bonds, it's not stocks, it's residential real estate.
Yeah.
And I just kind of felt like, the information out there, especially from the bigger publications and mainstream media, just isn't great. And so I just wanted to build a publication that was just hyper-focused onto residential real estate, whether you're a single-family landlord, agent, buyer, seller, homeowner, loan officer, builder, the whole spectrum across the housing sector is who I write for and research for.
It's really great because a lot of people in your space or kind of the related space really focus on serving the developers, the home builders, that kind of stuff. And of course, there's tons of stuff in the commercial real estate world, but I think your content is pretty well targeted at like single family landlords. And that's our audience too. So it's really perfect. Maybe the big broad question to start with, Lance, and by the way, we've got a whole bunch of things we want to cover with you, not the least of which is the big NAR commission lawsuit settlement that happened recently. And, is that really a nothing burger, or is it the big change the media is portraying it to be? We'll talk about that. But, just your view of the real estate market overall, supply, demand dynamics. Feel free to share any charts and graphs you want to put up on the screen as well.
Yeah, let me just go ahead and start sharing then. I think if big picture zoomed out, the most important thing to know about the United States housing market is that it's fairly tight resale supply. And so that should be your starting point with any discussion about the housing market, because from there, you can start to understand why different sectors and different subsectors within the market are reacting a certain way. And so this is my favorite metric. If you just gave me one number for a county or metro, or even like zip code, if I could get any number, I want to take inventory where it is now for active listings versus the same month in 2019. And what you will see is that on a national level, we're still down about 35%, 30% from pre-pandemic 2019 levels.
Before we go into that, so we're down 30 to 35% from pre-pandemic levels in 2019. Okay, great. But what I think people have to realize with that statement, Lance, is 2019 was by no means a bad market. It was by no means a buyer's market. I mean, we were doing solid business in 2019. Lots of people wanted to invest and buy nationwide. So there's all these comparisons from kind of the crash bro group of, hey, it's another 2008, right? It's another great recession. It's another financial crisis, or they think that's coming, I guess I should say. 2019 was still a pretty solid market, right? Would you agree?
Yeah, so 2019 was several years of falling active listings. They've been drifting down for years. And so 2019 was fairly low. Now, I will say that when you compare actives now to versus 2019, and if a market is at or much more above 2019 levels, they have seen more softness and more weakness, and maybe even some declines like a market like Austin. And one reason that it's weaker once you get to that level is because, 2019 was very much a seller's market and very low actives, but affordability now is so much more strained than 2019. Right. That is one thing that kind of equals it out a bit. But sure, you're absolutely right. But active listings throughout the U.S., the Northeast, very tight, the Midwest, very tight, Southern California, very tight, New Mexico, up into like Wyoming, very tight. through the South, you get some patches here or there. And really the reason for that is that the South had a good amount of, and in Central in Texas as well, had a good amount of new construction. So as the rates shot up and, some of those builders made affordability adjustments in some areas, some of the resale market, if sellers didn't come back a bit or got, kind of went too high, it gave actives a breathing room to rise. Not crashing. I would actually classify it more as normalizing, but still a tight resale market. And so if you look at this one, okay, see the very tight here,
Yep.
very tight out here, a little weaker through here, and Florida a little patchy here.
Okay. And by the way, you're saying here and there, and I just want to make sure people on audio only can understand this. So what he's showing is that overall nationwide inventory is very tight, very constricted. There are a few spots in Texas mainly and a couple of southeastern spots that show a little bit more of a relief in terms of a normal inventory market because builders were building there in a lot of those areas. There's just more land to build onto. If you have any comments on that, feel free, Lance.
Yeah, that's it. And then if you take that map and then look here, where you see inventory has moved up the most, some of them are kind of flat, mild price declines. And then a lot of those areas where actives are very, very tight, like Connecticut, for example, is down in most of the counties throughout Connecticut, down 80% from pre-pandemic levels.
Yeah, and that's probably a lot of that could be attributed to people leaving New York City, right?
It's the donut effect, exactly. Where during the pandemic, a lot of like those secondary markets like Austin and Boise kind of boomed and throughout parts of like Colorado and Utah. But as the offices started to reopen, what we started to see more was the pandemic migration and work from home effect was still there, like that work from home arbitrage. But what was going on, it was deeper into the exurbs, like places to where you couldn't reasonably commute into the office every day, but maybe you had to go into the office every couple of weeks or monthly, it was doable. And so really far out in New Jersey, I mean, Mercer County, New Jersey, it's up 11% year over year for prices, despite mortgage rates going up to 7%. And Hartford County, Connecticut is up 12.8%, despite, mortgage rates going from 3 to 7. So you really see that donut effect there. Yeah.
Talk to us a little bit about, Florida, Alabama, Tennessee, Georgia, Arkansas. These are markets a lot of our investors like. They're obviously very investor active markets. And I know it's spotty. Everything is, all real estate is local, folks. It's very localized world, but your map is pretty localized too. So
yeah. So what's happened in Louisiana in particular is there's been some home insurance shocks on top of the fact that we went through an overheating on price growth during the first 2 years of the pandemic. And then we had a rate shock going from 3 to 7. And then when you add in those home insurance shocks, that just puts a few markets where the affordability gets too strained. And everywhere in the country has essentially, during the mortgage rate shock, gone down for supply in terms of new listings coming into the market, the lock-in effect. And then everywhere has essentially came down on demand as well. So the market has been constrained to both sides. But what's happened for pricing is, in a lot of markets, if you went down for both, kind of like the Connecticut's of the world, this is just economics 101. If the supply and demand curve moves together, pricing can continue. And some markets we've seen demand pull back more than the supply pull back. And that's been the places that have softened more. And if you have that third affordability shock, where you not just the price shock, not just the rate shock, but also the home insurance shock, that's been some of the places where you've seen more of that demand pullback. And then some of the investors just having a harder time finding cash flow. And so that's created some of the weakness in some of those parts like Louisiana.
Lance, do you look at anything internationally? I'm just curious.
I'm very focused on the US housing market. So when I do things like international, it's maybe like comparing like our mortgage market versus.
And I remember reading this chart. Yes, that was interesting.
We're the spoiled kids. Yeah. We have, these fixed mortgages, 15-year, 30-year.
Yeah.
And that's an anomaly in the rest of the world. And so for them, they're feeling that squeeze of the rate shock more on the homeowner side.
Absolutely. Absolutely. Here's the reason I ask you about the international thing is that when you look around the world, amazingly, as unaffordable as everybody seems to feel the US market is, it's actually not that expensive compared to many markets around the world. And the US is actually sitting pretty well. It's like a semi-reasonable affordability here versus, you look at the UK and it's impossible. Just give up now, right?
So a few things there. And one core thing is that a lot of those countries don't have the American South and the Sun Belt, where
right.
they're very friendly to home building, and there's a lot of home building going on. And so the supply in the US, even though we're probably underbuilt, and estimates are somewhere between like 1 million and 5 million, we're still better off than a lot of those other countries
Right.
that have made it so hard to build.
Yeah. Yeah. Yeah, absolutely. But my point in asking you that was, there seems to be this kind of mentality out there that just because things were more affordable in the past, and certainly during the pandemic era, they were extremely affordable. But even before that, in the last few decades, right, things were, more affordable, that they have to somehow return to that, like they have to regress to the mean. And I think that's just a faulty idea on its face. Just because something was better in the past does not mean it has to return there.
I think one thing to keep in mind is, and I think everyone should go look and just kind of like Google housing affordability. When you take into account mortgage rates, home prices, and incomes, the 2010 to 2021, that was the best period ever, essentially. That was the lowest housing affordability or best housing affordability you can find in 50 plus years. And there's no guarantee we're going to go back to that. Now, what might be more likely is that, we've kind of gotten strained once we hit like 8% mortgage rates or 7. So maybe over time, if mortgage rates come in a bit and if home building continues to maintain and home price growth, maybe income growth could exceed home price growth for a bit, we could ease a bit on the affordability, but it's not going to take us back to pre-pandemic affordability.
Yeah. So I think those nostalgic times, we just have to understand it's very unlikely that is coming back. So that train has left the station, the ship has left the dock, whatever you want to say about it, from whatever cliche, just people have to just deal with that and make decisions now. The best time to plant a tree was 20 years ago. The second best time is today, right? Just move on, right? Yeah. A lot of people are stuck in that.
If you go back 2 cycles, really, or almost 3, and you go back to the early 80s when affordability was last strained to the levels that we saw at the end of last year, once we got to 8% mortgage rates. From that point on, heading forward, yes, affordability improved, but also home prices kept going up. So if you waited until the mid 90s when housing affordability really was improved relative to the 80s, because it was a slow grind down, home price appreciation had already ran really far up beyond those 1981, 1982 levels.
Right. Yeah. Yeah. And by the way, you mentioned cycles, go back, 2, 3 cycles. How long is a cycle in your eyes?
I think cycles can be measured different ways, but I think the way that I'm talking about with the cycle is really just, affordability getting strained, running up. So the last run up in affordability was like the 2005, 2006, and then the rollover, which is really, that period is a historical anomaly because that's just not how we've usually rolled off of an affordability being pressurized like that.
What else would you like to cover in this thinking about the market, where we are, where it's going?
One thing that's important is, and I don't know if I have a chart too handy here, but I guess I could look at this one to show a little bit of it. But one thing that has occurred is that the resale market has stayed tight, and that home builders, their profit margins during the pandemic went to the all-time highs. They'd never been as high as they were during the pandemic, and they had all the pricing power. Well, once mortgage rates shot up in 2022, what occurred is builders used some of those margins to do affordability adjustments, really mortgage rate buy downs. Some things are still playing out kind of like smaller homes going to meet the market. And they did all of that. And of the 10 home builders that I track, the 10 biggest publicly traded, 9 still have margins above pre-pandemic levels. So they went at the market and they still have above pre-pandemic level margins. And so what you haven't seen happen is a big hit to single family home building in terms of like the number of homes. Yeah, you've seen starts and stuff roll over, but in terms of the completions and stuff, we haven't seen a big hit. And multi, a lot of that's still rolling through the pipeline.
Multifamily.
Yeah. And so while the rate shock has caused layoffs for, mortgage folks, and some real estate agents have left, and title and some of that stuff on the pure transaction side. The big kahuna in terms of the transmission mechanism from housing to the rest of the economy, residential construction, has not rolled over. Builders made the affordability adjustments, came down a bit on margins, and continue to sell. And so residential construction employment is actually essentially at cycle high still. So I think that matters if you're, kind of a nerd and trying to understand how does housing impact the rest of the economy, and then also where does, the rest of the economy head forward. I would think if we're going to go into a harder landing or a recession, I would think, just based on history, that residential construction would have to roll over before that would occur. Maybe I'm wrong. Maybe it's, an outlier, but that's historically how it's gone. And right now, we're just not seeing that big hit to residential construction.
Yeah, and one comment on that is that the builders have a real shortage of workers. The average construction worker nowadays is basically around 50 years old. It's crazy how that has changed in the past few decades. I mean,
that's right. And so
these guys were 20 years old 3 decades ago. Just think about that. They're the same guys.
One theory is that there's some hoarding going on because the builders know, even if things were to change, right, or they were to slow, that long term, and especially in the next couple of years, things are good for them, they think, because, there's a need for single family homes in the United States, and they believe we're underbuilt. So even if we started to see a bigger hit to them, they might not make the job cuts like they would have in the past. And here's the largest home builder in the country. This is the margins for D.R. Horton. You can see during the pandemic housing boom, they just went to really high levels, right? They had all pricing power.
So D.R. Horton's margin during the pandemic, 31.8%, and now it's about 24.4%. That's a lot of pricing power. It's incredible pricing power. So before the Great Recession, going into it, their profit margin's 28%, but during the Great Recession, it's negative 10, right?
Yeah. So yeah, they've made some affordability adjustments with like the mortgage rate buy downs and stuff, came a little bit off the frothy peaks, but still in a fairly good spot.
One thing is interesting, and I think this is going to skew the statistics. I'd love to get your opinion on this, Lance. And that is that the builders have adjusted for the affordability problem, as you know, and they're now building smaller houses with cheaper finishes to try and meet the market and address the affordability challenges that people have. I think that's going to skew the statistics and give fodder for this argument that, prices are flat, or prices aren't going up that much, or prices are coming down. But the problem is it's not an apples to apples comparison, right? Because the house got smaller. Do you want to comment on that?
We're going to continue to see that heading forward. Is essentially we had 40 years of homes just getting bigger and bigger and bigger. Yep. And the housing bust that occurred actually hit the bottom of the market harder than the top. So builders can build more of the top, the bigger homes, right? And so we finally peaked out in like 2014, 2015-ish, 16, and we've slowly inched down. And you don't see it here quite yet because my data is lagging, but you will see a bigger drop off here because now you have two things occurring. You have the fact that there's the demographics and households are getting smaller in the United States, right? Yep. People are having kids later into life, more singles are buying, all of that. So that's the demographic tailwind that's going to reduce home size. And then what you said, which is the affordability side, is that the market now, because affordability strain, builders are like, you know what? I'll just get smaller on the home. And that's how they lower the price. Instead of actual outright cuts, they just build a smaller home to get that buyer.
So just to tell, if you're listening on audio only, 11 years ago, okay, or 10 years ago on the chart, because the data lags, like you said. So in a 10-year period, the typical new house got 300 square feet smaller, okay? And part of that was builders trying to address the affordability problems and sell smaller houses. They're obviously less expensive to construct, but also the demographic component of fewer people getting married, or at least getting married later, fewer people having children. Yeah, I tell you, that demographic problem is going to hit us by about 2050, and we're going to wake up and think we got to have some kids. But that's a different discussion.
But as an investor, you can kind of see it heading forward. Exactly. Yeah.
Lance, let's talk a little bit about all of these people that have these extremely cheap mortgages, and just rough numbers here, approximately 25% of the country has a mortgage at or below 3%. 65% of the country has a mortgage at or below 4%. Money is a commodity too. And they can't get that cheap money anymore. It is gone. There's no bargaining on money, really, right? Yeah, I mean, you can rate shop a little bit, but it's not going to be any dramatic difference. So they don't want to give up these great, really cheap mortgages on which they have, 28 or 27 years left, right? So
Yeah.
how do we ever solve that lock-in effect problem?
Yeah. So
if it's a problem that we don't have enough inventory, right? That's the problem. When I say it's a problem, yes, but if you own a lot of real estate, it's great because it's going to keep supply low, and that's going to put upward pressure on prices.
I think what we can assume is that there's not going to be a crazy amount of turnover in the market, right? Not a lot of churn, like this home selling and this person then selling it and going buying something else. And we were already seeing less churn, what I call churn, which is somebody selling to buy, but really, usually more broadly, they just call turnover, right? So what had happened over the past 10 years is that as baby boomers were becoming a larger and larger share of the housing market, and they were choosing to age into place, we were seeing less turnover in the housing market. So turnover used to be 7 years, and now it's like 12 years. Yep. And another reason that it got bigger is that there was a good number who bought before the bust, who were then underwater and they just couldn't sell, right? So we had those things come together that was pushing turnover up. We also had a few smaller things that don't get talked about much, like the fact that there's more reverse mortgages in the US, which has also helped to lock in people.
Yep.
But now we have a whole new lock-in, which is we had 40 years of falling mortgage rates. And then in, early 2021, we hit the lowest mortgage rate ever for 100 years, which is down into like the mid twos. And then we quickly, as inflation took off and mortgage rates moved up, it's created something of a lock-in effect. And this is probably the worst one we've ever seen. If you want to find one even comparable, you would have to go back to the early 80s. And so FHFA, the researchers over there published a 52-page paper last week, and they found pretty much what we already knew, which is there's a lock-in effect in the market. And they said this mortgage rate lock-in has led to a 57% reduction in home sales with fixed rate mortgages in Q4 2023.
That is staggering. I just don't want people to pass that comment by, Lance, because it is staggering. The mortgage rate lock-in effect has led to a 57% reduction in home sales. Now, these are home sales with these fixed rate mortgages. That's the ones they're talking about in the last quarter of last year. I mean, and that prevented 1.33 million sales in about an 18-month period there. So that's
home sales in the US are not down 57. The group of what I call churn, which when I say churn, I mean somebody who sells a home and goes and buys something else. Those people, those are the ones, the 57% reduction, because you still have the deaths, you still have the divorces, but of that churn side. And you could see, 1.3 million knocked off in 4, 5, 6, 7 quarters. And the crazy thing is that the economist over there, which they created this calculation, which is saying that this is the effect, the difference between the prevailing mortgage rate, which today is like 7, and the effective mortgage rate, which today is around 3.94, what impact that's having on home sales. And so they've created this calculation. And so when mortgage rates fall, sometimes it becomes positive effect. And when they, rise a bit, it temporarily goes the opposite direction. So like during COVID, when mortgage rates went down to like 2-3%, that was a positive, right, on the lock-in effect. And then as they went from 3, 4, 5, 6, 7, 8%, it's created a historic lock-in effect. And they do think that we've essentially bottomed in terms of like, this is the worst, right? In terms of the suppressed new listings. But if mortgage rate did go up another percent, they do think it could get a little worse. But even if mortgage rates fall a percentage point from today, it's still going to be here. And even if they fall 2 percentage points, so down to 5%, there would still be some type of lock-in effect for the next decade. So there's going to be a lot fewer existing home sales than there would have been had the pandemic and all the policies and everything that happened during the pandemic not occurred.
It's just staggering. It's a very different kind of world nowadays, folks, because of these long-term fixed rate 30-year mortgages. And we'll be back with a lot more on this topic with this guest on our next episode. Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.